Pending home sales are up more than 15% year over year, and the number of people applying for mortgages this week is up 31% for the year. Demand is obviously coming back into the housing market. The Federal Reserve met last week, and as predicted, many of the members are sounding very hawkish, and it's clear they're trying to keep the 10-year as well as mortgage rates higher than where they are. And it's working, because mortgage rates are now the highest they've been in 52 days. In the national market, housing inventory is now clearly in its seasonal decline, though new listings had a nice big jump this week, and we officially have a date for our first jobs report in 2 months now that the government is finally open again. We're covering all this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas-Fort Worth area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends, we're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button, and if you're looking to buy, sell, or invest, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is November 17th. Let's see what the data is telling us, and if this is an old video, you can click the playlist here to get to the latest weekly market update. First up is market news. As I mentioned, the Fed members came out very hawkish last week. I warned you of this in last week's video. This was totally expected. When the 10-year is near the bottom of this range, they always come out sounding hawkish so it doesn't go any lower, and they try to move it up. If the 10-year had been at the top of the range, they would have come out sounding dovish, so this is no surprise at all. And as of now, I believe there's a less than 50% expectation of a Fed rate cut in December. I think I saw like 42% earlier today. But remember, we haven't seen an actual jobs report in more than 2 months because the government's been shut down. So if we get some real softness in either of the last 2 jobs reports, then the odds of a December rate cut are going to go straight back up, which would cause mortgage rates to come back down. So we finally do have a release date for the first report, and that will be the September jobs report, and that's coming out on November 20th. And you should also know the Census Bureau is not expected to release the housing starts and new home sales data this week, but we should still be getting the existing home sales report and the home builder confidence data. So the government is back open, but it's still going to take a little time before these reports are released at their normally scheduled times. But either way, the Fed's remarks didn't cause a huge move. Rates are still very low compared to the rest of the year, and even today they're still a full 0.67% below where they were last year. And the main reason for that is what I really wanted to talk about in market news, which is the unsung hero known as the mortgage spreads. So if you don't know how mortgage rates work or who actually determines them, I've explained it on here before, but I'm hoping to make a standalone video explaining that in detail later this week, so be on the lookout for that. But the super short summary is you've got the federal funds rate set by the Fed, that's the baseline. Then on top of that, you've got the bond market fluctuating. This determines the 10-year yield. Then on top of that, you've got what we call the spreads. And all of these things are constantly fluctuating based on perceived risk in the market. So when I say the spreads, I'm referring to the literal difference between the 10-year treasury rate today and mortgage rates. So if the 10-year is at 5% today and mortgage rates are at 7%, then the spreads are 2%. That's the 5% plus the 2% gets you to 7% mortgage rates. And the spreads are determined by the banks and the perceived risk they see in the market. When they feel things are less certain, the spreads get worse as they think they need more of a cushion to protect themselves if things get worse. When they feel things are more certain, the spreads go lower. So that's the quickest summary I can give, but let's look at this chart. So this shows the spreads for the last 3 years, and this is largely the reason mortgage rates have been so high the last few years. If you'll remember the Silicon Valley bank collapse where everyone thought the whole banking system was going to implode, you can see that right here. Banks did not like that. They felt it was very uncertain. The spreads went straight up, and they were horrible for most of 2023. So you can see most of 2023 was sometimes over 3, but definitely in the high 2s most of the year. And that's why we saw mortgage rates get all the way up very briefly over even 8%. Then you can see the following year in 2024, things started to feel more certain and the spreads were already way better than they were the previous year. And then now this bottom line in 2025, you can see the spreads are significantly lower. And this is the main reason we have mortgage rates in the low 6s finally. And you should know historically the spreads are still super high. They really only should be around 1.6 to 1.8%. So if mortgage spreads were back to normal today, if they were just to go back to normal today, mortgage rates right now would be as low as 5.85%, even without the Fed cutting or the 10-year Treasury rate improving at all. That's how important the spreads are. So if the spreads continue to improve just back to normal, and then the Fed continues to cut rates, you can see how very quickly we would get much closer to a 5%. Pretty quickly. Remember, 5.85% would be if the spreads were normal today. Then the Fed cuts would take it even lower. And just to contrast, on the other hand, if mortgage spreads were way up here where they were the same week a year ago, they'd be 2.91%, and that would actually put mortgage rates a full 0.78% higher today if we just had the spreads as bad as they were in 2023. Again, that's without the Fed doing anything, without the 10-year doing anything. This is just the bank's perceived risk. So these are super important. Nobody ever talks about them. And when the media and the whole world is telling you that everything's collapsing and everything is scary, well, look at what the banks are telling you. They're perceiving less and less risk every year, and we're trending back towards a normal market. And I just feel like I need to say this even one more time. This is not dependent on the Fed or the bond market at all. They don't have to move even one bit for this to get back to normal. So even if the Fed never cut rates again, mortgage rates are going to continue trending down. You can see that trend happening over the last 3 years right here. Just look at the spreads, you can know rates are going to continue down. Now, of course, we do know the federal funds rate will continue down, but even if it didn't, you already know it's going to continue down just from the spreads. I hope that makes sense. Now moving on to property showcases for the week. Last week I showed you 3 listings that I was listing last week, and 2 of them already have offers. And we're planning to counter those today. So if you were interested in either of these homes, you need to call me right now before we execute an offer. The first one was this beautifully renovated home in Lakewood, listed at just $1.33 million. It's a 3-bed, 2.5 bath. It's got 2,379 square feet. If you didn't see that one last week, you can see the full tour here. It's fully renovated. All the major systems on this home are brand new. It's an incredible home with a huge yard, which is so rare for Lakewood. And then the next one is this really great 4-bed, 2-bath. It's 1,829 square feet. It's the perfect little starter home in Richardson, zoned to the 10 out of 10 rated Mohawk Elementary School. Obviously, both of these houses are priced very well, which is why they've already got offers in just a few days. And I just want to tell you, if you are considering listing your home, it matters who you hire. It's not normal for homes to contract this quickly in this market. Good homes, priced accurately and marketed well, will still sell quickly. Even now at the end of the year around the holidays, and maybe even more so because there are less and less new good listings to choose from every single week. And as you've already seen and will continue to see in the data, there's still plenty of home buyer demand. We have more than 30% more people applying for mortgages this week compared to a year ago. If you price your home right and market it well and get it in front of all those buyers, someone is going to buy it. So if you're considering selling your home and you want it professionally showcased like what you see in all my videos, then call me today to schedule a listing appointment. I genuinely believe every home deserves world-class marketing regardless of the price point. That's how I treat every listing, and as you can see, it works. Okay, moving on, let's start with national housing inventory. This week we had a decrease of 2,736 less homes for sale in the country, and as you can see, we very clearly should now be in our seasonal decline for the year. It's about this time that it happens, maybe a little bit later, but last year it was about right now. So this little move drops us to 16.28% more inventory than we had last year. If you'll remember, a few months ago, we got as high as 33% more inventory than last year. Now we're down to 16.28%. Which again is just a sign there are more buyers in the market. Inventory was growing quickly when there was more inventory than buyers. Now there are more buyers than inventory coming on, so it's shrinking. But this week we have 839,506 homes available for sale in the country, and this same week last year, down here, inventory was only at 721,980. So still much better than last year. Then for reference, the inventory bottom here of 2022, we only had 240,000 homes for sale. The peak of last year, we had 739,000 homes for sale. And again, right now we're at 839,506. Now looking at new listings, this week we had a nice jump. That's unusual, as you can see. I mean, well, last year, it looks like if you had shifted all the data over 1 week, then we'd be doing kind of the same trend, but we're definitely above. But we had 1,770 more new listings than last week, which is actually 5,419 more than a year ago. That's this gap, for a total of 57,251 new listings this week. It's pretty unusual given that we did have a holiday. Usually that causes all the data to drop when there's a holiday week. But what you can clearly expect is for the rest of the year, less new listings to choose from every single week throughout the end of the year. So once again, there are still plenty of buyers in the market. they're going to have less new options to choose from. If you have a good option and you market it well, it's still going to sell. Now moving on to weekly pending sales, which you could call new single family contracts this week. You can see new contracts are really increasing compared to a year ago. Again, just showing that buyer demand is in the market. New contracts increased this week by 3,933, which also gives us this huge gap of 15.36% more new contracts this week compared to a year ago. And that's actually the second week in a row where we've been about 15 to 16% more new contracts. I mean, you can see this data does swing wildly, but to have 2 weeks in a row around 15, 16%, that's a big deal. And as I mentioned, last week was a holiday week. That usually drops all of the data, and instead we actually went up during a holiday week. That's not normal, and it's clearly showing there is more strength in the market than there has been. But we had a total of 60,722 new contracts this week. The last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, we decreased 0.2% this week, which means very little change for the 11th week in a row. We've just been going straight sideways this whole time. So we had 41.5% this week, and we've actually been between 41.5 to 41.9 for the last 11 weeks. So a very tight range. But as you can see, we're following very closely to last year's trajectory, and the expectation is we're going to start to trend down and probably end somewhere around here. But last year we got as high as 39.9%, the year before 39.2%, and then back in 2022 we got as high as 43.2%. So we're not going to hit that high this year. We're going to be trending down, but all you need to know is if you want home prices to continue down, this number would need to continue going up. So home prices should be about as low as they're going to get for the year already. Now looking at mortgage rates, we started last week at a 6.34. We ended at a 6.38, and we're starting again Monday at a 6.38. We had no change today, which again, you can see this is after the Fed's remarks. We just went up not very much, really, not very much. And we're about the top of this range we've been in since around 9/18. We have a clear bottom over here at around, is exactly 6.13 up to 6.38. Yep, right here again, 6.38. So that's our current range, and we're just at the top of it. We have not broken out above or below. Then looking at mortgage purchase applications, this is our best leading indicator to what demand will look like 30 to 90 days from now. And we had a big 6% increase week to week in the number of people applying for mortgages, which puts us an enormous 31% year over year above last year's demand. That's this huge gap. I mean, any way you look at it, there is more demand in the market now than there has been in at least the last 3 years. And this gives us 38 straight weeks of positive year over year growth. But I've been saying it more than a year now. I still believe it. There's no reason to believe that real buyer demand comes in until rates get and stay below 6% for a sustained period of time. The evidence we have of that, new construction has been offering that for a long time, and they've still been selling way more efficiently than pre-owned homes. Okay, moving on to the local markets, we're starting with the MLS data of Dallas County. This week we only had 495 new listings. That's 9 less than last week, and actually the only other time we were below 500 listings was back here at 488. I know that was a holiday week as well, so just trending with nationally, we can expect less new listings every week. So we're now below 500. We had 225 closings, which is 22 less than last week, and that has to do with whatever was happening at least a month ago. That's when those homes would have contracted. Of the homes that closed, 35 were immediate sales. That's 5 more than last week. And immediate sales means they contracted within the first week of listing. This week we had 274 new contracts, which is 11 more than last week. So look at this, 253, 239, then we jumped to 263, now we're up to 274. We're getting more new contracts, and this was even during a holiday week. That's not normal. That shows more demand. And in total, we have 1,985 homes either under contract or pending. That's 55 more than last week. Now the same thing looking at Collin County, we had 380 new listings, which is 28 more than last week. And 380 actually looks right in line with what we've been seeing, but it's 28 more than last week. We had 205 closings, that's 15 less than last week. 23 were immediate sales, meaning they contracted in the first week, 2 less than last week. We had 169 new contracts, that's 23 more than last week, and that's really in line with where we've been, 64, 82, 77. We had a drop last week at 46, but we bounced right back to 169. So 23 more than last week, contracts are more in the normal range, whereas Dallas actually looks like it's increasing. But when I say in the normal range, it's actually not normal because it should be decreasing at this time of year. But in total, 1,818 homes either under contract or pending, and that's 55 more than last week. Now we're moving on to the Market Action Index, starting with Dallas County. If you've never seen it, all it does is take into account all this data and put it into one easy to read graphic with a number. Anything of 30 or below is a buyer's market. Above that, we're asking how much of a seller's market are we in? We just use this to see, are things looking normal or are things looking unusual? What's normal at this time of year is things should be cooling off and trending down through the rest of the year, all the way through January, and then maybe start ticking back up in February and definitely in March. The most unusual thing that's been happening this year is prices have just been holding very firm. We have not broken below 400. The first time it happened was August 22nd, and we've gone straight sideways since then, all the way to November 14th, never gone below 400 on the median list price. Median price of new listings, similar story. Outside of this 1 week on August 22nd, when things dropped, we've been going just straight sideways. We're actually closer to the top of the range than a bottom. So price is holding firm, that's more unusual. You can see though, overall the Market Action Index is still showing that it's cooling, and that's normal. We're down to a 34.04. Average days on market going up, that's normal. So we went up by 1, we're up to 107. Median days, 77, and this only does 7-day increments. So we must be right on the edge to go 77 to 70 and then back up. But it would be normal for median to be going up. We're up to 77. Homes having price decreases, it's obviously dropped from where it was in August, but ever since September, we've really just been going sideways. Inventory clearly tried to bounce in September, and then the last 2 weeks has had a big drop, and we're actually below our previous low, which was 58.70, and now we're down to 58.55. So inventory is dropping. That is actually normal this time of year, if you'll remember our inventory chart. So everything's looking normal, except there is more demand than usual, which is simply keeping prices flat at a time where they normally would be going down. Now looking at Collin County, Collin County has pretty much always been cooler than Dallas County. It's a 32. The only thing is their Market Action Index, instead of trending more down like Dallas is, it looks like it's actually finding more of a bottom and going sideways. But remember, it is still cooler. So even if it stopped cooling, it's already cooler to begin with. But their prices have finally broken down. They were firm at 525 for a long time, and the last few weeks they've been coming down. They're all the way down to 510. I would be very surprised if this doesn't bounce back up next week. But even if it doesn't, that would be a sign of a normal market. Not something to be concerned about at this point in the year. Median price of new listings as well has been completely sideways, so it's just right in the middle of the range right now at 450. Average days on market went up by 2 days to 105, so much longer than Dallas. Their median days as well already has jumped up to 84. Homes having price decreases, actually going up. Still not at the top, but it's obviously a much cooler market than what we're seeing in Dallas County. So Collin County is much more representative of a normal end of the year market. Their inventory as well is dropping, which is normal. And again, their Market Action Index, not as low as it's been, but just going straight sideways. So nothing unusual in either of these other than Dallas County is holding more firmly on its prices. All right, now we're moving on to the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties, and these are ranked using that same Market Action Index number we just discussed, which means 30 or below is a buyer's market. Starting with the hottest cities, the absolute hottest remains Hutchins, Texas at a 40.89, followed by Grapevine at a 40.69, and then Coppell. Those three held their top 3 spots last week. Then Carrollton heats up 1, Lancaster heats up 1, Irving cools off 2, Plano heats up 1, Louisville jumps onto the list at number 8, Grand Prairie remains, and Richardson jumps on at number 10. So DeSoto, which was number 7, and Cedar Hill, which was number 10, they both fell off the list this week. Then we like to zoom into specific zip codes. The absolute hottest is Irving, 75061 at a 46.61, followed by Dallas, 75234, Hutchins, 75141, Grapevine, 76051, Plano, 75093, Louisville, 75077, Dallas, 75206, Coppell, 75019, Lancaster, 75146, and Carrollton, 75006. So if you've got a home in one of these zip codes or these cities, you should be able to sell for top dollar right now. Then looking at the same thing but the coolest cities and zip codes, remember 30 or below is a buyer's market, so all of these cities and all of these zip codes are officially buyer's markets. The absolute coolest remained this week, Nevada at a 27.18. Actually, Nevada Whitewright, Anna, and Royce City all remained in the coolest 4 spots, and then Blue Ridge cooled off 3, Salina heats up 1, Prosper heats up 1, Rockwall heats up 1, Farmersville cools off 1, and Van Alstyne jumps onto the list as the hottest city on the coolest cities list. Then Leonard, which was 9 last week, heated up off the list. Looking at the coolest zip codes, the absolute coolest is Nevada 75173, followed by Whitewright 75491, Dallas 75204, Anna 75409, Rockwall 75032, Royce City 75189, Blue Ridge 75424, Dallas 75204, Salina 75009, Irving 75039, which is a 28.87. These are the coolest cities and zip codes in all of Dallas and Collin counties. As always, thank you so much for watching. If you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. Just call, text, or shoot me an email. All that info is in the description below. Thank you for watching. I'll see you in the next video.